Welcome to the Dollar Debauchery program, brought to you by Küle's Notes, a daily consolidator on the most insightful presentations, articles, essays, and the interviews on the web on the ultimate confidence game, money. Our site presents ideas from the smartest and wisest money managers, economists, and analysts.
Hi, I'm Crystal Ferdinand, and I'm here with Küle's Dollar Debauchery program. And today we're interviewing David Morgan.
David Morgan, founder of silver-investor.com, home of the Morgan Report. I have a background in engineering and finance, economics, and I've been interested in the honest money situation for a very long time. I do a newsletter that's published monthly subtitled Money, Metals, and Mining. So that should give you an idea of what we do.
So David, what tools, economic theories, and financial forecasting analysis do you employ to analyze the precious metal markets?
My formal training was basically based on the Keynesian economic model, which I understood was inaccurate, to put it politely, from the very start. So I went into my master's program with a thorough, self-taught Austrian school approach to the economic reality of the world. And I've held that from a very, modest age, probably my early 20s onward, and I didn't go to graduate school until I was in my late 20s. Regardless, on the metals, I analyzed the big worldview picture from the Austrian school. But as a subset, I do use technical work. A lot of people say that technical analysis doesn't work in a manipulated market, but I find that not to be true. My calls have been pretty good, especially on the upside. I've caught every minor major top on the way up in silver. I called the 840 top. I got out a little early, selling in the strength, which you needed to, the $21 top and the $48 top. Technical work is not perfect. There isn't anything out there, but it is a tool, and it's a tool to use because, manipulated or not, all the data in those markets, and these are paper derivatives markets. Let's be very clear about that.
Right, yeah.
So I use a combination of fundamental and technical work. There's pure fundamentalists that think technicals don't matter. There's pure technicians that think fundamentals don't matter, and I think they both matter, and I think they both matter a great degree. The main thing on technical work is I've gone from very extreme, knowing every doggone way to look at a market, and it's just too much information, sort of like the age we're in, the over-information age. So I've got it down to a basic way to trade these markets that has worked very successfully for me, and I share that with our members on the upgraded service. It's not just the basic newsletter, but we call it Basic Plus, where they get the plus, or the benefit of watching all the video work that we do, and anything that I do where I make a video showing where I see the markets in the current time. So that should suffice.
So what is your explanation of why gold markets and silver prices have gone down this year after the decade-long bull market?
All markets move on buying and selling pressure. And to be totally honest, which I am, the silver market really got ahead of itself, not really to fair value, but it shot up from $19 to $48 in a matter of months. It went from really 26 to 48 after the QE2 announcement. And even myself was saying, look, this thing's getting overextended, overdone. If you have to buy silver, please don't buy all that you want. Save some cash. And I did that in the $30 area, 35, something like that. And I did call the top. I said, if you're trading these markets, or even if you're not, and you have a big position, you might consider to hedge it or selling some or something like that. So I did my best to try to caution people that this market had accelerated to an extreme momentarily. Any market that goes up with that big a move, I don't care if it's soybeans, wheat, the stock market, the tech rec, bonds, or of course what we have now, the debt market looks very similar, by the way.
That's true.
Then that's a market that you want to be very, very cautious of, and from my experience and abilities, say, look, we should stand aside with part of it. Now, I don't want to misconstrue this in any way. I trade a maximum of 25% of the portfolio and hold on to the other 75% as a core position. But my core positions were entered at a much lower price than the $48 top, where I did sell off some. I didn't sell any physical. I played the paper game back at them. In other words, I used derivatives. So because of the over-acceleration in silver in the end of April 2011 and September for gold, any normal market, non-manipulated market, would still take some time to kind of consolidate that kind of buying pressure. And that's the formal way to say it. The informal way is that, yeah, these markets are definitely looked at, and how manipulated are they could be argued, but certainly almost every market out there, in my view, is manipulated. I mean, if the interest rate market could be manipulated, what can't be manipulated? The money supply is manipulated, so the basis of the whole entire financial system is a great, giant, huge manipulation. I mean, so if you have any logic ability whatsoever, and if the start basis is a dollar system that is created out of nothing and totally manipulated for the benefit of the big banks, and everything else stems from that, then what market isn't manipulated? Come on, people, let's think about this. So I'll leave it at that.
Oh, okay. So are Western central banks selling gold or leasing gold into the market? And if you think that, what levels and to what extent is this happening?
Well, on the demand side, China's basically buying up anywhere from about 3/4 to maybe a total year's mining supply, and they seem to have an insatiable appetite for physical gold. Almost all of the kilo bars manufactured out of one of the major refineries on the planet is going to China. Singapore has certainly gotten in the act here lately. So the real world of gold versus the derivative market of gold are completely different entities. However, they are tied together basis the price mechanism. So when a price function takes the price of gold down as an example, you could do it with the paper markets, and actually if you were buying a large enough physical quantity, it could work to your advantage. In other words, since there's leverage in the market, you could sell enough using 5-to-1, 10-to-1, 100-to-1 leverage to drive the price down with $1 on 10, and then come into the market physically and buy 10 times, or buy physical amount that's greater than the amount of exposure you have in the derivatives market. So is that done or not done? You could think about that. But regardless, what the flow is, it's west to east. How much is coming out of the west? Hard to say. It's got to be coming from somewhere, obviously. But what we do know is that the Indians and the Chinese are, are thanking us every day, so to speak. Meaning the markets that are allowing $1,200 gold or whatever. I think they realize from a long-term perspective that's probably not nearly fairly valued, let alone overvalued at this point in time.
Do you think precious metals are influenced more by inflation or deflation, or both?
Very interesting question, and I'm going to give you kind of my academic take on this. You can argue both sides. I've studied it for years, and the take I have is this. In modern times, gold and silver both seem to be more wired toward inflation, especially silver. But the best study in not that recent times was Professor Jastram, Jastram, and he wrote a book called The Golden Constant. And his argument of using gold against all commodities was gold actually did better in a deflation than it did in an inflation. However, we got to be careful with the terminology because the monetary system has gone through several different trial and error periods, I'll call it, where you had a sound money system, so gold was actually money during a great deal of the study that he conducted. And then there are times when there isn't a gold backing at all and you have a fiat system. So it's really difficult to say. I'm a big believer in the near-term data is more important than what happened, 50 days ago, 500 days ago, 5 years ago, 50 years ago, although the historical perspective for some thinking is very important. But from is it more biased toward inflation or deflation? I think you have to look at more current data to make an analysis.
That's interesting.
Silver, after Jastram did the Golden Constant, he wrote a book called Silver, the Restless Metal, because he had the same question I had after reading the Golden Constant. And what does silver do in an inflation deflation? I did a speech on that in Vancouver in January several years ago, and one of the few speeches I actually had to make some notes. But there were periods where it did good in the deflation and bad in the deflation. So silver is more of a mixed bag than gold. But it's definitely, his conclusion at the end of the book, or actually I think it's in the preface of the book, was that if there were ever to be high inflation, that silver would probably be the best thing you could possibly own. And I would agree with that. So regardless, they both have real value always and everywhere. They may not be at the same paper price that you purchase them at, unfortunately for people that are in that position, but they're never going to zero. They're outside the banking system. There's a lot of advantages to physical precious metals that no other asset has.
So what is the effect of Federal Reserve quantitative easing policies on precious metal prices?
Very good question, and one I think that a lot of investors are asking, especially precious metals investors. Because if you go back to when the QE program started, as an Austrian, it's a very simple thinking or thought process, and that is that any increase in the money supply is inflationary by definition. So when QE1 was announced, that's an increase in the money supply. That is inflation by definition. Therefore, inflation hedges should do well. And we saw, that take place pretty much during that phase of the market. Then QE2 came out, and silver did what I just spoke about a moment ago, that Professor Jastrom had indicated, that in a highly inflationary time, silver would probably beat the pants off of any other thing you could imagine. And for that time frame, it probably did, from $19 to $48 in a matter of months. Go check the chart. But the amount of QE2 really didn't cause any inflation relative to, one, the government's nomenclature for inflation, and two, really on the ground basis. Certainly there was more inflation than by government's statistical models, but nonetheless, not the kind of inflation that everybody, that you talk to on the street saying, oh my God, I can't stand this amount of inflation. Butter's going up, gasoline's going up, rent's going up, everything's going up. How do I get out of this? It wasn't that type of inflation. So what happened, in my view, is that QE3 and on, really the markets have now understood that all of that inflation, which we should call it, has gone in the banking sector only. It really hasn't gone out in the market. And of course, that money has to go somewhere. So you have to just, be a bit of a private detective and take a look and see where, if or where a bubble is being created. And generally speaking, it's pretty much two things. It's the debt bubble that continues to inflate, although the bond market probably has peaked, but the air is coming out very slowly and very manageably at this point. And then the equity market. And the equity market, of course, can absorb a great deal of new money, but it still has to relieve that pressure, as we said earlier, buying and selling pressure. We've got buying pressure to the stock market's going up. So the precious metals have been kind of a second thought, or a third or fourth thought to most managed money, pension funds, hedge funds, and individual investors, because price action creates commentary. And the price action has been to the downside. So that's about all for the last couple of years. So that's all you really hear is gold's not a good investment, gold's down, gold's off, gold's down again today, that type of thing. And this is normal in a bull market. Again, manipulated or not, most markets that are huge bull markets will shake off most people. That actually challenges their belief system or their conviction. And that's not true of the hardcore, but it's true of the peripheral. And it's called the weak sisters are selling. So that, I think, is what's happened. And then, of course, this idea that the QE2 or 3 is going to cause inflation, and it really hasn't anywhere but in the equity markets, that people are discouraged, so they're giving up. So has it had an effect? I'd say, yeah, QE1 and 2 did. QE3 and on hasn't. In fact, it's probably been negative. What's been the purpose? The purpose is to keep the banks solvent.
And do you see the possibility of gold confiscation in the future by any other governments?
I do see a possibility of a gold-backed currency of some type. I don't know exactly, and no one else does. Well, maybe someone does, but very few, if anyone, knows how it's really going to play out. I do think it's possible you could have a gold-backed yuan. It could be a gold-backed Chinese currency. It could be a gold-backed one world currency. Who knows? I do think that you're going to see more and more pressure toward gold in some form for some stabilization into the monetary system. I mean, when you go back to the fixed exchange rates that took place, it was a much more stable system. And now you get moves in the currency markets that you wouldn't see in a year or so in earlier times. Now it's just taken for granted that you get these kind of swings because it's, again, recent data and younger people and that type of thing. But the type of moves that you have in almost all markets now are high volatility relative to where they were, say, in the 60s and 70s when we're on, the U.S. dollar standard, really. And even after it broke and we were into free floating currencies, all for, one for all for one and one for all kind of thing, where they all competed against each other. they really still traded in rather narrow bands relative to what you see today. So right now, with it's kind of a free-for-all, who can print the most to get the best type of an attitude, it's a very unknown, uncharted region that we've really never been in before on a global basis. And that's been one of my founding principles, that this area that we're in financially has never been this widespread, this globally intertwined. It is a global market. And so as the dollar goes, it'll have repercussions basically on a global basis.
So what are your short-term, medium-term, long-term forecasts for gold and silver prices?
All right. Short term, the prices are going to be, I think we've seen a bottom in silver, probably in gold. I think there's the Chinese put. I think the Chinese are pretty happy with $1,200 gold, and if it went much lower than that, they'd probably just buy more. So there is a point where the physical market absolutely has influence on the price of it. So I think we're going to see the next 6 months an upward trending market for both the metals, but I don't expect anything that significant. Markets go down faster than they go up. In a bull market, it depends, especially the silver market. It's much more difficult to analyze, in my view, than the gold market. Regardless, if you have a 6-month downtrend, in a bull market, it might take 6 months to get back up to the same level. So I'm thinking you're probably going to see, the $1,500, $26 level in silver, $1,500 gold type of thing. It could do better than that. I'm usually conservative on my projections. And then over the course of the next 6 months, so a year out, I think you're going to be looking at silver in the 30s, maybe 30 to 34. Gold probably 1,700 or so. But I want to give a caveat, and this is assuming that the conditions that we see 6 months to a year out are very similar to the ones we see today. In other words, there's no financial upheaval, no big bank or too big to fail happening, no huge financial event, because in the event that there was something like that, both these metals could take off very quickly, very rapidly, and you could see, huge moves literally overnight. So, and then out further, I'm looking for probably the 2016 time frame, maybe 2017. So really within the next, 3 years or so, where the general financial system understands beyond any doubt that the United States and all other countries are really not taking care of business. In other words, they are going to try to print their way out of the situation and not being fiscally responsible. And when the market will clear, the market has its own knowledge, so to speak. So what will take place is you will see asset classes of what I call the real things, the commodity sector primarily, where gold and silver are the top tier of all commodities because they're money and they're treated that way. And those will accelerate more than probably anything else. But anything real will be coveted, and anything that's debt-based will be trashed. And since all currencies are debt-based currencies, you'll see currency upheavals. Not to say that the yuan might do a lot better than the dollar, because everyone knows that China is buying gold. But, I think the big question you could ask would be, who owns the most gold? I mean, if you go to the internet, you look it up, you see the United States, still states that they have like 265 million ounces on the books, but no one's seen it for a very long time. And when Germany want their small amount of gold back from the New York Fed, they said, no problem, 7 years from now, you can have it all back. So that begs the question, if the U.S. has got so much gold, then what's the problem giving Germany back their gold in a reasonable amount of time? I think 7 years is an unreasonable amount of time. So the question really is, who owns the gold makes the rules, the old adage. Who really has the gold? Where is it? Is it encumbered or not? Who has, really the best fiscal responsibility for the way they run their sovereign nation, if you can even call them that anymore? So there's a lot of questions out there. But wherever the market determines, and no one can pinpoint at this point in time, that this problem was not going to go away and it's not going to be resolved, the market itself will take actions to resolve it. And in my view, very studied view, what you'll see the gold and silver and commodities markets take off. Land, of course, depending where it is, you'll probably see anything you can go touch that has value and can stay a long time will probably increase in value. And anything, as I said, that's debt-based is probably going to be in dire straits.
Thank you, David, for joining us here today. And thank you guys for joining us here for Cliff Kúle's Dollar Debauchery program.